Good evening, everyone. Welcome to the class on investment management. And the topic for the today class discussion is technical analysis. So whenever we are trying to analyze a stock, so till now you have understood why the stock should be traded in the market. So you have understood what is IPO, what is FPO, what is right issue, what is private placement. You have heard of all these terms. So whenever a company raise money in the form of equity, and if they raise money from the public, automatically that become a public issue, and the market from which they raise the money, that is called as primary market. So in the primary market, IPO, FPO, right issue, private placement, qualified institutional placement, all these terms comes, all these instruments comes through which the company raise money. So once the company raise their money, then they enter into secondary market. So whenever we talk about secondary market, in the case of secondary market, the stock should be listed on the stock exchange, and once they are listed on the stock exchange, then their trading happens, and because of trading, they goes up and down. So because of their trading, the price of the stock goes up and down every day. It's because of demand and supply. It depends upon the perception of investors about the market, because of which you can see the stocks of different companies are going up and down. If you have seen the recent web series called Harshad Mehta 1992 scam, so there you would have seen many traders are there, and they were using pump and dump to inflate the price of the stock. And once they feel that the stock has reached to very highly appreciated level, then they try to dump all their stocks, and thereby they try to make a lot of profit. So that is a very common strategy which many traders used to follow. If you have followed Ketan Parekh, so Ketan Parekh, after Harshad Mehta's scam, so there's another person who was by profession was a chartered accountant, and he was working under the Harshad Mehta firm as an intern. So after that Harshad Mehta scam, the next scam which came was the Ketan Parekh scam. So the Ketan Parekh basically was using circular trading in the market. So Ketan Parekh had lot of companies with him. He had lot of brokers, some brokers, traders working for Ketan Parekh, and within themselves only they used to buy and sell stocks. So thereby, for the normal retail investor, they try to create kind of atmosphere which looks like that particular stock has a liquidity, and because of the liquidity, the stock prices is going up and down. But that was only done by the Ketan Parekh and its company associate people. They try to pick those stocks which are small cap companies, small cap stocks. So normally small cap stocks are such kind of stocks which normally the like HNIs and other institutional investors, they don't give much emphasis on. So small cap stocks are the stocks having a market price of very less value, and again they are not so liquid stock. So the trader like Ketan Parekh, they used to create an artificial demand for these stocks by using circular trading, and thereby, if the retail investors get an eye on those kind of stocks by looking at the volumes of the trading, ultimately, retail investor think that they may be the fundamentally the company is strong, and because of there will be certain reason why their stock price is going up, and when they could not able to understand the concept of circular trading which the Ketan Parekh and their associate were trying to create on the stock. So and thereby they fall in the trap of that. So whenever you day by day basis, whenever you observe the different stocks, so those stocks their prices are going up, their prices are going down. So whenever when we see the stock, when we see the movement of the prices going up and down, whenever we try to analyze in stock, because whenever you're trying to buy in stock, if you want to do long-term trading, there are a lot of traders, there are a lot of individuals are there who participate in the stock market, and the participation is only day trading. So if you are someone who is like a day trader, then for you doesn't matter much about discussing about the breadth of the market, the valuation of the company, or the future perception of the company. If you are someone who will look at, then being as a day trader, then what matters for you is is to buy or sell those stocks which have volatility, and by playing on volatility, a day trader try to maximize the profit. So a day trader never go with fundamental logic of realizing the movement of the price of the stock. A day trader only look for so the directions, either up directions or down direction, and a day trader try to gain from the direction. So, but if you are someone who want to do long term investment, if you are someone who analyze and stock, and he or she want to predict that what would be the future likely price of the stock, maybe next days ahead, and then on that basis, if you are someone who want to do investment for long term period, then definitely it is important for you to analyze the stock. And whenever we try to analyze the stock, we can analyze the stock by two ways. Either we can follow fundamental analysis, or we can follow technical analysis to analyze the stock. So whenever we talk about fundamental analysis, so in the case of fundamental analysis, we try to see the fundamentals of the company. We try to see what is the business model of the company. Once we see the feasibility of that business model, so how feasible is that business model? How much we can see breadth in that business model? What is the life of that business model? All that we need to consider in mind. We need to consider the competitor of that company, how the competitor is performing with respect to this company. So once we have that basic understanding, then we can look into the management of the company. Once we have seen the management of the company, then we start digging our brain onto the financial statements of the company, like profit and loss statement, balance sheet, cash flow statement, fund flow statement. Like fund flow statement talks about the working capital management of the company, while the cash flow statement talks about the inflows and outflow of cash. When we talk about P&L, profit and loss, talks about the operating expenses and operating income of the company, and the balance sheet talks about the financial composition of the company. Looking into all these data, looking into all these statement, us to get a better understanding of the stock, how we can realize that stock. So once you have seen the balance sheet, profit and loss statement, statement, fund flow statement of the company, then we can do ratio analysis. We can talk about different forms of ratios of the company. Either it is a fund, either it is liquidity ratio or leverage ratio or profitability ratio or activity ratios. And then after considering these ratios and comparing the ratios of the company, one ratio of the company with their competitor same ratio, by that we can have develop a basic understanding of how we see a company altogether. So one of the very basic ratios what we look whenever we talk about the fundamental analysis is the price earning ratio. So price earning ratio is one of the very key parameter a fundamental analyst always look whenever a fundamental analysis talks about doing investment for the long term region. So price earning ratio is one of the very important ratios. Many investor, many fundamental analysts will say you that you should prefer price to book value ratio more than the price to earning ratio. Again, it is a very controversial terminology, that which should you give more preference, price to earning ratio or price to book value ratio, which ratio you should give more preference. So whenever we talk about P ratio or price earning ratio, so we are comparing the market price per share of the company with respect to the share of the company. So that basically what P ratio talks about, while price to book value ratio talks about the movement of the price, 1 unit of the price company with respect to the 1 unit of the change of the book value of the company. So whenever we talk about book value, so the book value or net worth, that basically talks about the internal equity of the company. So any company is a strong company if they have good internal equity. Internal equity is all about reserve and surplus of the company. So more reserve and surplus shows more internally the how stronger a company is there. So whenever you see price to book value ratio, so you should give preference to price to book value ratio more than price to earning ratio, because whenever we talk about earning per share, so earning per share is nothing but is actually derived from the total earning of the company divided by the number of shares outstanding. And whenever we talk about earning, earning is just an accounting outcome, so which you get after you deduct all the expenses from the revenue of the company. So revenue again, it can be credit revenue because we follow accrual mode of accounting. And then when we talk about expenses of the company, so in the case of talking about expenses of the company, we have certain entries like depreciation, amortization, which are non-cash expense for the company. So again, altogether, EPS or earning per share is nothing but it's just an accounting outcome which we get after we deduct all the expenses from the revenue of the company. So on price to earning ratio won't be very good realization whenever you look into the investment for a company. So more than price to earning ratio possible if you want. We can give an eye on price to book value ratio, because price to book value ratio basically accounting worth of a company. So as an investor, you can give preference to price to book value ratio more than the price to earning ratio. So again, both can be equivalent to each other. But yeah, but for a fundamental analyst, ratios like P ratio, price to book value ratios play a very important role. So whenever we talk about fundamental analysis, 1 minute. So one minute. Whenever we talk about fundamental analysis about for a stock, so fundamental analysis whenever we do, so fundamental analysis of a stock. So so what all we need to consider. So whenever we talk about fundamental analysis, you can see that. So the purpose of doing fundamental analysis is to figure out the worth of the company, how much we can find the worth of the stock. So fundamental analysis is all about finding the security intrinsic value by examining the related concepts of economics and financial factors which ultimately affect the security value by considering both microeconomic and macroeconomic factors. So and then ultimately the objective whenever we do fundamental analysis is to figure out is the stock is valued or overvalued. But whenever we talk about technical analysis, whenever we talk about technical analysis, in the case of technical analysis, we simply look at the directions of the price through the analysis of historical market data such as the price and volume. So whenever we are talking about technical analysis, in the case of whenever we discuss in the case of technical analysis, in the case of technical analysis, the historical data of the movement of the price and the volume of the stock, and by looking at the historical data of the movement of the price and the volume of the stock, we try to predict the worth of the stock. We try to predict that theoretically how much the stock is undervalued. So that is what we do in the case of technical analysis. So fundamental analysis is all about determining the stock real or fair market value. So if you remember, I have taught you in the equity valuation model. I have taught you constant growth rate model, two-stage growth rate model, three-stage growth rate model. So all that was a part of fundamental analysis, where mathematically we try to figure out what can be the worth of the company. So that is what we do in the case of fundamental analysis. So it uses the public data to evaluate the value of the stock or any other type of activity. Okay, whenever we talk about fundamental analysis, we look into the data like revenue, earning, future growth, return on equity. So ratios are very important. What is return on equity? What is the return on investment? What is the current ratio? What is the quick ratio? What is the inventory turnover ratio? So it's important to see these factors before as an investor we talk about doing investment on the stock. So that what fundamental analysis basically do. So fundamental analysis basically consider a different qualitative and quantitative factor which help the investor to go for analyzing the undervalued stock, and if that undervalued stock can be identified, then doing investment on them will not be big consideration. Qualitative fundamental factors which can be looked into, they can be business model, they can be competitive advantage, they can be management. Okay, then it can be corporate governance. So all these are very self-explanatory terms. I hope you are understanding these terms. These terms are very basic and self-explanatory. So now when we talk about quantitative factors which we need to consider whenever we talk about fundamental analysis, those can be quantitative factor can be can be the balance sheet of the company to consider, then to consider the cash flow statement or to consider the income statement, and ultimately you see fund these statement already I have discussed about them, and then we do ratio analysis, and by looking at the ratio analysis ultimately we try to understand the worth of the company. So what is the cash position of the company that we need to figure out. Okay, so going further, in the case of fundamental analysis, we just try to derive the concept of intrinsic value of the stock. So how could we determine the intrinsic value? Intrinsic value is very subjective term, and determining intrinsic value, which can be dependent on lot of quantitative and qualitative factor. So that would be a tough decision to go through. So in the case of fundamental analysis, we just try to do hard work so that we can realize the fundamental value of the stock. And that is what we do in the case of fundamental analysis by looking at different ratios. Either those ratios can be based can be EBITDA to enterprise value ratio. So either those ratios can be P ratio, price to book value ratio, price to sales ratio. It can be EBITDA, enterprise value. So by considering these ratios as an investor, what an investor try to do by looking at into these ratios, either it is price to sales ratio, either it is current ratio or quick ratio, or price to earning ratio. Okay, then by considering these ratios and by doing the valuation, what we try to do in the case of fundamental analysis, we try to out those stocks which are undervalued in nature, which have strong possibility to generate income or the inflow of the cash in the future. So that is what we do in fundamental analysis. Going further, then fundamental analysis, then we talk about technical analysis. So this is what technical analysis is all about. Everyone wants just make a read, everyone. So I believe you have done some reading about technical analysis. So whenever we talk about technical analysis, in the case of technical analysis, we just see the historical data. We see the historical data case of technical analysis, and by looking at the historical data, we just try to predict the trend. So in the case of technical analysis, in the case of technical analysis, the purpose is to identify the trend. Here we are not interested in determining the intrinsic value of the stock, what we used to do in fundamental analysis. But instead of that, we use charts and other tools to identify the patterns which can decide or which can help us to identify the future activity. So in the case of technical analysis, we not only rely on the charts, we use technical indicators, oscillator, or maybe sometime combination of indicators and oscillators to identify those stocks which can lead to the trend, what they have used the trend in the past. So that is what we do in the case of technical analysis. So in the case of technical analysis is based on certain assumption that let the market discount everything. Then the second analysis can be the price moves in the trend. So this is the second factor, and the third factor is the history tends to repeat itself. This is very important thing in the case of technical analysis. So this is what we try to do always. We just try to figure out the pattern which can repeat. So which repeat means which can again come. So market discount everything because already you have read about efficient market hypothesis. You know that ultimately the news what comes about a stock ultimately affect the price of the stock. So either good news or bad news ultimately make the stock price to goes up and down. So whenever any news comes, automatically the effect of the news will rely on the stock, and then slowly that effect will be gone. So after 2 days, if you enter into the trading by considering that news which came 2 days before, then nobody will be interested to do trading with you because he or she we don't have knowledge about what has just happened about the market. So when we talk about market discount everything means any news which comes about the stock in the market, ultimately that will be digested by the market, and then again the things will become normal. So then the next thing, the case of dependencies is the price moves in trend, and whenever we check the movement of the price. So whenever we talk about the movement of the price of the stock, so this is the same in the case of technical analysis, is that the stock either follow uptrend or the stock either follow downtrend. So uptrend means if it going, it will go up. Downtrend means if it going down, it will go down. So to identify the strength of this trend, how stronger is that strength? We use something called ADX, Average Directional Index in technical analysis, to identify the strength of this trend. So these are all our basic terminologies and basic understanding in the case of technical analysis. So whenever we are trying to analyze the stock in the term of technical analysis, we look into the historical data of the stock, and by looking into the historical data of the stock, we try to identify we try to identify the factors like price and volumes, which have the possibility to repeat the same trend what has just happened in past. So that is what we talk about when we talk about the concept that history tends to repeat itself. Okay, so it's not only stock, we can use the logic of technical analysis even in commodities or futures and options or forex, anywhere we can use the same concept. Technical analysis is important, and the term which can be used in day-to-day trading purpose. Fundamental analysis, technical analysis, these are the differences you can see. So which is better? Can they coexist? So you can read about this. So in the case of techniques, the purpose of working on techniques is to identify the trend. So you can see this. This is called candlestick diagram. This what you see. This is called candlestick diagram. Whichever you see the red in color, that means that day the market has went down. And in this candlestick diagram here, what the blue color, what you see that shows the day when the market has went up. So candlestick diagram is one of the very important parameter whenever we talk about technical analysis on the stock. So in order to do candlestick diagram, we will talk about candlestick diagram somewhere later on. So but before that, I just want to tell you that in the case of technical analysis, the purpose in the case of technical analysis is to identify the trend, and once that trend is being identified, then possibly working on that trend is not would be the difficult task to do on. So, so the trend can be uptrend, downtrend, sideways. So you understood these all are the terms which we can easily understand. So whenever you see the movement of the stock or index anything, you should know these two terms. One is called support and other one is called resistance. Support is the minimum value while resistance is the maximum value. So that is what we see. So every day, whenever you see the market has opened, so you before the market is going to start trading, you need to identify that day support and resistance. So that is very important. Support is the maximum value by which the stock can fall down, while resistance is the maximum value by which the stock can go up. So you should understand the term like in a day the stock price goes up and down. So the maximum it can fall, that is called support, and the minimum it can rise, that is called resistance. So every day, if you refer any broker or doing stock market trading, so they will introduce this term support and resistance, and many anchor initial also introduce this term. So we need to understand the scenario of the discussion here. So here the discussion what we are trying to do, that whenever you see the stock and you know that because of demand and supply the price stocks goes up and down. So here what is to identify here to identify the trend, and whenever we are trying to identify the trend, you should know these two terms: what is support, what is resistance. Okay, so that is very important to do. Channels and all are not important. Okay, so support and resistance. So these are the basic. You can read this. I'll send you this for your basic reading. You can read them to understand the concept of support and resistance. Then you should, as a trader or as an analyst, you should always look into the price whenever we talk about the trading part. So it is very important that the price and volume they should move together in the same direction. So because if the price and volume if they're moving in the same direction, that shows the strength of that trend, what is happening. Because there can be people like Ethan Parekh who can start doing circular trading. So it is very important that we should keep an eye on the volume along with the price of the instrument. So that is again very important. So as an indicator or as a chartist, you need to look into the volume also. You can see here. So earlier diagram what you saw that was only price. So here you can observe the volume also with price. Volume is very important aspect of technical analysis because it is used to confirm the trend and the chart pattern. So any price movement going up or going down. Okay, so with relatively high volume is seen as a stronger, more relevant move than a similar move with weaker volume. Therefore, if you're looking at the larger price movement, then we should also examine the volume of the trading to see whether it will tell the same story or not. So say for example that the stock goes up by 5% in one trading day, and after being downtrend, is this a sign of trend reversal? Trend reversal. So this is where the volume has traded. If the volume is high during the date related to the daily volume, then it is a sign of reversal, and it is possibly for real value. Okay, so on the other hand, if the volume is below the average, then there may not be enough conviction to support that this is the true trend reversal. Okay, so volume should move with the trend. So if the price are moving in upward trend, and volume should also increase, and if the previous relationship between the volume and price movement start to deteriorate, then it is a sign of weakness in the trend. So it is very important that the trend should be developed in much more appropriate order. Okay, so I hope you are getting the logic. Volume and the chart pattern, all that different charts are there which we can use. You can look into the price of the stock to see, get the chart and all. What you can do if you are looking for a chart, what you can do, you can go to nscindia.com. Now here you choose any stock. Here you can choose any stock. Let's suppose Simpla. Now suppose this Simpla, so you can see this. You can see this company. What is the face value? Face value of the company is 2 rupees. It means that tomorrow if this company will bankrupt, they will give only 2 rupees per share to the shareholder. So you can see this. The traded volume, free float market capitalization is 37,720 crore. 52-week high is 829. So 829 is the resistance, while 52-week low is 355. So 355 is the support. Lower price band, upper price band. So you can see this, you can read more about the company. But here right now I'm more interested with historical data. So if I see here 1 month historical data, and if I download this data, now what you can do, you can draw the graph. Consider the closing price of the stock. So now you can see the date by I got the closing price of the stock date wise. This is descending to ascending, so make it ascending to descending, oldest to newest. So once you get this, Once you get this, now what you can do, you can plot the graph on this. So you can, now you can see this. So this is very simple line diagram you had drawn. So by only looking to the closing price of the stock, very simple line diagram you have drawn. So if you want, you can, the way you want, you can change this diagram. So you can do that. If you want, you can change this also. Closing price of the Cipla. So you can see this, and the stock closing price, the stock price going up and down, you can see that part. Okay, so if you want the return and all, you can calculate the return on the stock. So if historical data is given, I hope you remember how you will find the return on the stock, or to find the average return on the stock. So you will do the total sum of the return divided by the number of return. How will you identify the return on the stock? So you will divide today closing price minus yesterday closing price. Okay, divide by yesterday closing price. So this is the way you get the closing price, you get the return. So once you get the return, you know how to find the standard deviation, average return and all. So these part, everyone can do this part. So this is just a line diagram which you can draw by considering the closing price of the stock. So along with considering the closing price of the stock, if you go to Excel, in Excel altogether, a lot of charts are there. You can see a lot of charts are there. Under stock, you can draw these charts. So here you need high, low, close. High, low, close. If I take high, low, close, let me take the date. Take the date. Now high, low, close. This is high, low, close. Last traded, put in closing. So high, low, close. Take this data, put it here. Now what you do, select this data. So here you go to stock, here high, low, close. So you can see this. This is again the diagram which you can see. So you can see this. So you can see this part. So this upper end is the highest price. This is the highest price. This is the lowest price. And this what you see, this is the closing price. So this is the highest. This is the lowest. And this is what you see. So this is the highest. This is the lowest. This is the closing price. Understand this? So this you can draw the diagram. So this is the way how you can see day by day basis. You can see the movement of the stock, how the stock is going up or going down. That movement you can do here by considering this part. So just in way, whenever you get in stock, you can look into the highest, lowest, and closing price of the stock. whenever you are trying to make an analysis about the movement of the stock. Okay, so this is just a way to consider the movement of the stock. Okay, anyone have any doubt? Any question you want to ask? So technical analysis is all about looking at the historical data, and whenever we see the historical data, based upon looking at the historical data, how you can identify the trend. So how strength is that trend? How stronger is that trend? All that you can do. If you can develop the uptrend or downtrend, then what is the possibility of that uptrend and downtrend? So all that we do all the hard work to figure out the possible momentum, what can be happen in the case of stock. So normally, whenever we talk about technical analysis, then there are a lot of tools we can follow. So ultimately, in technical analysis, we believe that what has already happened will happen again. So the objective is to predict that movement before time. If we can do that, then our work is done. So like randomly, I just opened Reliance Industry. So you can see this Reliance Industry. So today Reliance Industry fall down with negative. It has fallen down by 0.45%. Now you can see this chart. So this chart which I've drawn by going to nscindia.com, and then from there I downloaded the data, and then in Excel I plotted that graph. You don't have to do anything here. You can see this, the movement of the stock. So day by day wise, what is the movement of the stock? So if I see December last year, it was trading around 1500 this stock. Now the same stock is trading at 2000 or 3000, 29 something. So compared to last year, you can see the stock has actually went up. But if you see today, it is fall down by 0.25%. So you have to understand this value. What you see, that negative 0.45%, that is one day-to-day basis. What is the movement? So you should not simply look into the day-to-day basis. So you should have a horizon in your mind whenever we consider investment in the stock. This is 6 months, last 6 months, last 1 year. You can see all that. So last 6 months, what has happened in stock. Last 3 months, 1 year, 5 year. So you can see last 5 year. So 5 years before this stock was at 500 rupees. Now this stock has went till 2000 rupees. So fundamentally, I think you can understand this stock is actually very strong stock to do investment. 1977, when Reliance Industry came up with the IPO. Then the IPO price was 10 rupees. Now this is trading at 2200 rupees. So you can imagine. So if somebody would have done investment in 1977 in the Reliance Industry, then how much that person would have become so popular and rich. So that consideration you can understand this. But anyway, that is not the point of concern. So we are more interested here to study the technical analysis. So technical analysis, whenever we talk about technical analysis, you can see these ratios which are discussed already in the past. The face value is 10 rupees. Okay, so when we talk about technical analysis, you can talk about the basic charts and advanced charts. So you need to study these terms in technical analysis. One is Bollinger Band, then exponential moving average, envelopes, parabolic SAR, simple moving average, then indicators, accumulation, distribution, ATX, average lifetime index, ATR, average to range, CCI, check-in money flow, or stochastic oscillator, MECD, moving average, convergence, divergence, a money flow index, then on balance volume index, a rate of change, RSI, relative vigor index, standard deviation, tricks, volume, William dot percentage R. So all these are the indicators which we'll discuss. Then draw. So in draw, So trend line, crosshair, Fibonacci retracement. We'll discuss about them tomorrow. Then chart type. Tomorrow I'll teach you how to draw candlestick diagram. Tomorrow we'll discuss drawing candlestick diagram. This diagram what you see, this is called candlestick diagram. Tomorrow we'll start our class, a discussion with candlestick diagram only. Okay, so these are basic technical indicators which you should know, either that is accumulation, distribution, ADX, ECI, stochastic oscillator, William dot percentage R, on balance volume, RSI, MFI, so tricks, so all that we need to study. So then only fundamentally and technically we can be more stronger if we have basic knowledge about ratios, plus at the same time if you have basic knowledge about these parameters whenever we do investment in the market. So technical analysis is all about predicting the trend, believing the fact that what has already happened will happen again. So if it happened again, so how much we are prepared to get the hold of that change. That is what we are trying to study whenever we are trying to study the subject called technical analysis. So anyone have any doubt, any question you want to ask? Anyone, any question? Anyone want to ask any question? Any question, guys? So this much is for today class. We'll continue our discussion from next class.